European Debt Crisis 2010. The contents of the presentation can explain and answer the following questions. 1. Explain the background of the case study. The European crisis that started with the debt crisis in Greece has spread to other first-tier European countries, such as Ireland and Portugal. The transmission of this crisis did not stop in first-tier countries, because it then spread to second-tier European countries, such as Italy and Spain. Wide deficits and inefficient and targeted use of debt were the main triggers for the crisis, in which the ratio of debt stock to GDP in several European countries, e.g. Greece and Italy, was at more than 100%. Meanwhile, Italy is the largest government debt market in Europe and the third in the world after the United States and Japan. On the other hand, France is the largest holder of Italian, Spanish and Greek bonds compared to other European countries. The fall in the value of Italian, Spanish and Greek state bonds as well as the economic turmoil in these countries will sooner or later spread to French and European banks. 2. Explain how are the effort, policies and obstacles, challenges of the European Union in dealing with this case. Prove it with existing arguments or data. Eurozone leaders have taken steps to save the region from a debt crisis. One of the important decisions taken was the establishment of the European Stability Mechanism, ESM, on the 27th of September 2012 with the aim of bailout Eurozone member countries facing financial difficulties, assisted by Troika, International Monetary Funds, European Central Bank and European Commission. Likewise, the Eurozone countries agreed to increase the standby fund for bailout, from €500 billion to €800 billion or around $1 trillion United States dollars. This standby fund is not only to help euro user countries which are struggling hard to get out of the financial crisis, such as Greece, Ireland and Portugal, but also to anticipate other countries that need a bailout from ESM. Other measures to save the European region are the haircut in payment of Greek bonds to private parties. Banking and insurance groups agreed to reduce their receivables to Greece by 50%. For Greece, the reduction in debt obligations from the private sector is very meaningful, not only for saving their country from the debt crisis but also for the European region. Another European economic rescue policy is the European Union Leaders Agreement on Direct Bank Recapitalization, where a banking bailout in a country can be done directly by using existing European bailout funds. For this reason, the euro area also agreed to unify its banking supervision. Thus the rescue of troubled banks in the Eurozone will not increase the government's debt, so it will not add to the national debt burden. In addition, a bailout fund for Greece of $56 billion United States dollars was finally approved by the IMF and Eurozone finance ministers after a long debate. EU leaders hope that these measures will protect Greece as well as Europe from a protracted economic crisis. Even though various policies have been taken, the large debts of European countries and the slow pace of economic reform have made their economic recovery slow. In fact, the deteriorating economic conditions in the European region forced the rating agencies to downgrade the debt ratings of European countries. 3. Explain how did the domestic and international community respond to the case. The domestic community responded to the European debt crisis of 2010 with a variety of measures, including austerity measures, financial assistance programs, and structural reforms. During the European debt crisis of 2010, many countries implemented austerity measures, which involved cutting government spending and increasing taxes to reduce budget deficits. Financial assistance programs were also put in place, such as the European Financial Stability Facility and the European Stability Mechanism, to provide loans to struggling countries. Additionally, structural reforms were implemented to address underlying issues in the economy, such as labor market reforms and pension reforms. These measures were aimed at stabilizing the economy and preventing further financial crises. Some countries implemented strict budget cuts and tax increases, while others received bailout packages from international organizations such as the International Monetary Fund and the European Union. The crisis also led to political unrest and protests in some countries. 4. Were the efforts and policies of the European Union successful in handling the case? Done. Explain your reasons by providing strong arguments or data. Simply put, one of the primary reasons why and how the debt crisis ended was that the European Union gave Greece a financial assistance package, because it encouraged the European Union, which was formed by member countries of the European continent on the basis of regional economic and political strengthening, which was realized through the cooperation of each country due to the interdependence of the countries involved. The interdependence relationship that exists between EU countries makes one country vulnerable to problems, and that country's problems will affect the countries around it. The economic problems that occurred in Greece will affect the EU economy due to the fact that the international organization has a single currency, which causes financial relations between one country and another. Therefore, when one nation feels interdependent on another, the interdependent nations will always maintain the stability and harmony of their relationships. The EU also granted Greece FAP because the Greek problem could have broader consequences if it is not resolved swiftly. A decline in the region's economy as a consequence of the crisis in one country represents the greatest threat to Eurozone nations. Consequently, the FAP strategy is a rational response to preventing an identical disaster in other European nations. Another reason for the FAP policy is also driven by the EU's role as a regional leader and stabilizer. As a leader, the EU is responsible for the economic problems faced by its member countries. In fact, the EU's inaction in dealing with the Greek crisis was centered on the debate between Germany and France regarding the FAP. France is a supporter of FAP while Germany rejects it. However, after being pressured by internal EU circles, namely from the ECB, European Central Bank, and Greece itself, as well as pressure from external EU circles, namely from the US and the G20, Germany finally agreed to give FAP to Greece. Give your critics and suggestions about how the European Union should handle this case. New steps are needed to ease Greece's debt burden. One option is to extend the maturity of the long-term loan assistance that has been provided, by giving loans to Greece, which may be sufficient to cover Greece's loan requirements in the coming years. In return, the Greek government should release an economic and financial policy declaration to make up for the borrowing. The agreement promises the government to minimize spending cuts and raising taxes, with the goal of reducing the public nation's deficit. Greece needs debt sustainability and more realistic tax targets.